Let's bring in Andrew Slimmon. He's Senior Portfolio Manager at Morgan Stanley Investment Management. And Peter Boockvar is Chief Investment Officer at One Point BFG Wealth Partners. Welcome to both of you. Peter, how important would you say the ripple effects from the ongoing situation in software and private credit are relative to now this oil price spike that we have to deal with?
Well, you take private credit generally, and the credits are lower quality, so much more sensitive to the economy around them. The interesting thing about private credit is that, according to Fitch last week, their biggest default rates are actually in healthcare providers and consumer products. Software was number 3. So this is wider than just a software thing. And if the global economy gets negatively impacted because of the sustainability of higher oil prices, which I'm not necessarily thinking that's going to be the case, but if it is, well, then again, you're dealing with lower quality credits that are with less quality balance sheets that are going to be much more susceptible to an economic downturn.
Right. I mean, look at some of the issues with, the KKR fund. That was a lot of 2020, 2021 loans. And we know the biggest issue before the software problem hit was higher interest rates. On that front, Peter, do you expect that on the margin we're going to have higher or lower interest rates as a result of what's going on with energy prices?
Well, it's an interesting response that the global bond markets, and I emphasize global because we've seen a rise around the world in sovereign yields because of the worries about higher inflation driven by energy costs. If you look at the Fed funds futures this morning, last Friday we were pricing in 100% chance of 2 cuts and 40% chance of a third. Now we're down to just 1 cut with about a 65% chance of a second. So the bond market is quickly adjusting to and saying, hey, with this jump in oil prices, whether it's sustainable or not, there's no way the Fed can be cutting interest rates going into this, which is important because if this leads to something more economically and oil prices and other commodity prices stay elevated, the Fed's going to have much less ability to address it via rate cuts.
Andrew, this reminds me a little bit of the 2000s cycle where there was this whole debate about whether interest rates were too low or should go higher because you had oil prices and energy prices moving up while at the same time the housing bubble was building. So I don't know if you would say that episode is instructive at all for what we could be going through now, and whether you think inflation or basically a consumer shock are the bigger possible sort of issues here to deal with because of what we're seeing with oil and gas prices.
I don't think you're going to have a consumer shock, Kelly, because we also have tax refunds that are starting to hit. So maybe more of those tax refunds will go towards gas at the pump. But I do think that is an offset. So I'm not as worried about that. But what I do think is happening is there was such a consensus that the dollar was going to weaken this year that, it doesn't surprise me we're having a strengthening of the dollar. And with that, on a relative basis, you're seeing more money come back into kind of the very large U.S. stocks.
What, Andrew, does that make you want to do positioning-wise? Does stronger dollar mean, let's look at what was working the past couple months. It was international stocks, commodities. Does the stronger dollar upset that apple cart?
Yeah, I think it does. And I think what is intriguing is if you look at, really every quarter last year, these companies reported, U.S. companies reported great numbers. But money, kind of went elsewhere. And the result was the S&P was only up by the magnitude of earnings growth really last year. And now you have companies that reported fourth quarter and they were great again and their stocks are down. So I think this is an opportunity to really look for companies that continually raise estimates and the stocks are weak. And there's a lot of U.S. companies. I do agree, though, with some of the comments about software. Look, we're early in how that industry is going to be turned upside down. I'm not sure I would necessarily bottom fish in that area.
I was just about to ask. So if you had to pick between tech and energy, where would you go, or would you go somewhere else altogether?
I wouldn't. I'm not a big believer. I'm a believer you own enough energy to not get hurt in these types of instances. But over time, it's a commodity, and so I think this is the opportunity as the market is selling off other areas to really look for that dislocation between fundamentals and stock prices. So I would not chase energy. And I do notice today, oil is up a lot, but the stocks are, not up a lot. I wonder whether, that's kind of showing some tiredness already in that area.
Peter, what would you say?
Well, even with this rally in energy stocks over the past month, and it's been one of my favorite groups that we own coming into the year, it's only about 3% of the S&P 500. So while tomorrow the Strait of Hormuz can open up again and oil prices are going to fall right back down again, I still think that there's a fundamental bull case for the price of oil. And when the price of oil was in the 60s, I was arguing that it's one of the cheapest assets in the world. So I still like oil stocks. We're long them. And but I also think that the non-AI trade, which has clearly been a trend, is going to continue. So I think focusing on other boring things like consumer staple stocks, which we're long, is also a strategy, and that the overall AI tech trade is exhausting itself, and investors need to look at other places for returns.
Yeah.